You're not going to have Jensen pulling large semiconductors out of his oven if that's the case.
Maybe that's his happy place, man. Maybe he doesn't like, maybe that's a low stress environment for him when he's cooking the semiconductors. This keeps coming up. You're so fascinated with him cooking semiconductors.
Yeah, because he looks good in an apron and a leather jacket.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Work with it.
Oh, how's my didgeridoo today?
He's good. He's good. I've been America again for a week now.
Yeah, you're loving it, right?
I'm just turning nasty. It's great.
You yelling at people yet? You like pushing old ladies down on the street?
Every day. I set like a calendar invite so that I can make sure at least every hour and a half someone hears my Americanisms.
Be a good American today, as you reminder. By the way, those
exactly.
If you don't get those jokes, listen to the previous episode, folks. All right, what's up, man?
What are we digging into? What's crack-a-lacking? We done touched on this multinationally before. You talked about it in China a couple years back, lying flat. We talk about how people were kind of working two jobs, but one was just like a mouse wiggle, just so they can get paid.
Yeah.
I'm bringing you something from Axios here that is claiming the American dream has lost its hustle. Couple points I'm going to drop on you here, and I think it's discussion fodder. So I want us to see what your thoughts are. One, it says, the key to job satisfaction turns out, at least for a substantial minority of workers, to be the ability to be happy in a job where you're not excelling or even trying to do so.
I don't know about that one.
Say more. I want to talk about it. I think it's discussion fodder.
Just let me digest that one. The key to happiness in a job is
to be happy in a job where you're not excelling or even trying to do so. So what this is going in the face of is, if you say traditionally, let's go back and look historically, would be show up at your job, put in the work, and you get joy out of doing hard work. Let's just take that, some version of that historically. This is saying that now there's at least some portion of workers where job satisfaction is about not excelling, not even trying to excel.
It's about what, like watching TikTok on your phone and getting paid? I mean, what's the implication here?
Ooh, look at you using the SAT words. I'm going to drop a second one, and then we'll talk about implications. Money buys happiness. Work buys stress. So one smart post-capitalist move can be to work enough to be happy, but not so much to be stressed.
I don't have any pushback there. I try not to do too many personal stories, but I'll one of my first professional jobs went through the great financial crisis, as did everyone else. So 2007, 2008, workforce gets cut in half. There's layoffs everywhere. And as part of that, I ended up pinch hitting in doing other people's jobs that were technically lower than my pay grade, but that's how it worked, right?
Yep.
And one of those jobs was a pretty mindless, important, foundational, but pretty mindless work where you could, if you got really good at it and were competent, you could almost read a book and do the task at the same time. And that was
I just want to see that.
That was fun, man. That was like, if you look back on my professional development in this odd way, it was a pretty happy time because I was like so intellectually stimulated by trying to juggle. It's almost like playing a video game to do all these things at once. And then it wasn't super stressful. It was, and also like that was when I was first really diving into the Intelligent Investor and a bunch of other like really challenging financial concepts. So I'm on board with that. I mean, sometimes you need a job that kind of is low stress, I think, is the most important thing here.
What I wouldn't want to do in this is to paint a binary picture necessarily, where on one side it's about just working enough just to do that job, and the other side is you're stressed out and draining yourself. But on the implication front, because you asked that question, on the implication front, what I think about is how do you get the innovations and productive tension and the what gets churned out by people wanting to strive to grow, to improve? Like how do you end up getting that in a world? And that doesn't mean that everyone needs to be that. I think that's where I don't want to paint the binary picture.
Yeah.
But if you go to like an extreme, right? We talked about NVIDIA. Can you picture someplace like NVIDIA, which the whole purpose of that organization is to innovate, to find new ways of working, to figure out how you can, whatever they're going to do, AI the crap out of this world, whatever.
Yeah.
And folks are just like, I just want to put in just enough. But if I touch stress, then it's a no-go. You're not going to have Jensen pulling large semiconductors out of his oven if that's the case.
Maybe that's his happy place, man. Maybe he doesn't maybe that's a low stress environment for him when he's cooking the semiconductors. This keeps coming up. You're so fascinated with him cooking semiconductors.
Yeah, because he looks good in an apron and a leather jacket.
He looks good in all ways. So yeah, let's keep going because I hear your non-binary point. I think it's important, but let's also not pretend that everyone in the world's goal is to be intellectually stimulated and challenged at work. There's a lot of people that for them and the way it was modeled to them, work is punch the clock, do a decent job, get your money, and go have fun elsewhere. There's no right answer here.
I agree. What ends up mattering in my mind, so there are a couple things. One I just mentioned, if you take this in aggregate, do we still get the innovation and the growth? And when I say growth, I don't necessarily mean like GDP figures going up necessarily. I just mean improvement, right? In general, upon like personal and professional development, whatever it might be. There's that side. The other thing as an individual is I hope that people understand the benefits that come to them. And then like what's been necessary for others to succeed even. I'm taking this, so I'll even be more blunt here. When I think about this, we talk about eliminating the wealth gap a lot, income inequality. And when I look at this from the perspective of minority groups, and I'll just say like when I look at younger Black folk, to be even more specific, sometimes it feels like there isn't an understanding of what the balance is between pushing back on like the system and doing the thing that you need to do in order to get out of the situation. And there is a balance. I think it shouldn't be like because on one side of the equation you can be like, I'm just going to go along with whatever the system says so I can be successful. That's like one side. And another side is I'm just going to rail against the man. I think there's a balance of figuring out how do I get to the point where I can get myself, assuming that someone wants to drive, maybe not to be wealthy, but at least drive to be like stable. And if you're trying to drive that, I just feel like some people just don't fully grasp the fact that there isn't entitlement. Like there has to be some stress that exists. Don't be stressed out. This is where, am I making sense?
You do make sense. Again, so depending on your goal, let's assume that you're an aspiring young chap who wants to go conquer the world, right?
Yes.
Not everyone's in that camp, but let's assume that. Regardless of who you are, there's a really important thing I think that needs to happen that not everyone is blessed enough to see, which is a peek behind the curtain of the organization that you run at what the executives actually value, actually care, realizing that in 99% of the organizations, everything is negotiable, including salary, job title, everything else. But so I don't think as many people as I'd like get that peek behind the curtain and truly understand like how the organization runs and what is valued, because once you know that, it's pretty easy to get your hustle on, like to use the terms of the article, right? It's pretty easy to grow and aspire and, go excel.
Yeah.
But I think a lot of people are flying blind and saying, this is what my boss says. Your boss is sometimes a terrible role model of how to play the game to move forward in that individual company.
Yeah, agreed. And I do not believe that there's a generation of people that are lazy, right? Which I think sometimes is what can be. The article's not saying that, but sometimes that can be what's portrayed. I do not believe that at all. I do believe that something that might be different about current generations is that you have access to more information, and you also have a more comfortable life than others in your same situation historically. Meaning, if you are in, let's call it the 50th percentile of the US today, economically, you are much better off than the 50th percentile of the US economically 50 years ago.
Yeah. I mean, what's the saying here, Doogles? It's like when times get too easy, when people get too blessed, they get complacent. And therefore,
exactly,
that leads to challenging times. And then out of those challenging times come stronger individuals, and it cycles through. And like, there's no doubt if we just go back 100 years, the life of a 17-year-old in America is significantly easier and more blessed than it was previously.
I just hope we're not getting complacent, to your language. That's it.
I think we probably are. I mean, how could we not be?
I just hope we're not. I hope we're not. It's easy to see these days. It's easy to get the anecdotes. There is so much information on the other side too. There's just information out there. You can interpret it however you want. And so what is happening on the ground is always tough to fully know, but we can see the anecdotes. We can see whatever data, interpret it however we want. I just hope that ultimately it's not about complacency. It might be about pushing in different areas. Like maybe the spikes are going to be different and the innovation is going to look different than it has before, which would be awesome. I just hope we're pushing it all, even if the pushing is not in your 40-hour-a-week job. Maybe the pushing is somewhere different, and so that we just have growth in different areas. I just want to make sure we're not stagnant and complacent as a society. I'm gonna leave it down.
I'll tell you, this article mentions the Reddit thread anti-work. I'm gonna check that out. See what the hot topics are. What people are talking about when they're anti-work.
Do it.
I'm gonna pull something out of my fishbowl that we didn't even talk about, the pre-show meeting. But guys, as you know, sometimes on this show we like to pretend you're at a pub and you have some investors, couple drinks in, debating topics. So there's no takeaways from this. I'm not asking you to take action. This is something that's been going on in my brain for like 2 weeks, and I need to talk to Doogles about it. So from memory, Apple, the stock, makes up like 46% of Berkshire Hathaway's portfolio. And Apple's sales have started to slow. Now, granted, they'll release a new iPhone in September in all likelihood, and who knows what happens down the road. Their services business is growing off the charts, and so there's some positives there. But I'm talking, Apple's like 3 times what any other equity holding in Berkshire Hathaway's portfolio is right now because of the incredible growth it's had, and because of I mean, people are claiming now that Apple might be Buffett's best investment of his lifetime, which I don't believe, but like that tells you how good the returns have been for him.
From an absolute dollar perspective, I'm sure it is.
Oh, yeah, but from an absolute dollar perspective, it just means what happened at your end of life when your dollars compound.
Exactly.
But anyway, let me give you some stats, Doogles. I'm just of the camp that like Buffett kind of has to pull back. He has to sell some of this because it seems it's not like Nvidia crazy high, but it certainly seems on the high side of fair. And Buffett doesn't have to do anything. He has more money than he could ever spend, and his company is still sitting on $150 billion in cash. Like, he doesn't have to do anything. But I think just the investor side of him has to start to be thinking about, hey, is this a little over its skis? And I'm interested to see how he wants to have that, or how he wants to handle that. So did I set that up well before I give you some stats?
Yeah, you set it up well.
If you're Buffett right now, what are you doing? How are you thinking about your Apple position?
Right now, I'm waking up in the morning with peanut butter on my chin.
He sleeps with peanut butter like on his chest so he can have some when he first wakes up.
Exactly. Yeah, what I'd be curious to look at before you even go into the stats, what I'd be curious to look at is Berkshire Hathaway's portfolio over time and what the top like 3 holdings concentration wise have been. And then secondarily, what the relative valuation of each of those holdings are. I'm curious how much Apple is a full anomaly in Berkshire's history. I would bet that it kind of is, but I don't know.
Yeah. So from my just memory of his portfolio and watching it evolve over the past 20 years, it feels like this is one of his highest concentration bets. But I'll pull some stats on that maybe for next time. Here's the thing I wanted to give you, comparing some Apple valuation metrics, their current position versus their 5-year position. These are straight from Morningstar. So price to sales currently at 3.7. The 5-year average is 6. Price to earnings is at 30. 5-year average is 25. Price to cash flow 25. 5-year average is 20. Again, it's not like crazy. It's not NVIDIA. It's just on the high side of fair, or the high side of historical average. Enterprise value currently like 2.8 trillion. 5-year average is like 1.9. I mean, so it just feels like it's no longer a deal. Like, I'm not buying Apple today. Even if someone was giving me a 20% discount, I'd be like, there's better deals in the market. I still think it's a great company. I still expect them to continue to print cash, but it's kind of all those factors, Douglas, where it's like, you're at 46% of your portfolio. It's probably, there's probably some profits to take. What's he going to do?
I think the question that you're asking, if you're at Berkshire, is what is Apple going to be worth in 15, 20 years? And then who cares about the rest? I think that's the question, because if you look at it in a different way, you could say Apple is the most valuable company in the world. It's at the high end of its average. And I'll just say, this might not be true, but I'm going to put this out there. Inevitably, there's going to be a pullback. Okay. So it's at a $2.8 trillion enterprise value. Let's say that pulls back and you're at $1.9 trillion. In 15 to 20 years, are you going to be at 3.8? Then who cares? I think that's the question. I don't know the answer right to that, but I think that's, if you're at Berkshire, that's what you're asking, is does this have the capability to increase by another 50%, let's call it, over the next 15, 20 years? And it's 46% of my massive portfolio. What does that do for cash flows? I think that's the question you got to ask.
Yeah, I just did a massive eye roll, and it was at you, but it wasn't directed at you. It was directed at Buffett. I'm not a Berkshire historian like half the world is, right? I kind of follow it, but I don't care that much, right? So I'm pulling up some stats, and we can actually look at these things. So one, Buffett, a guy that often says, like, think about investing as if you get 15 total trades in your lifetime, or I forget the number, maybe it's 20, right?
Yeah.
He's still a guy that buys or sells stuff every quarter. That, like, his so I pulled up his 13F so we can watch how many trades he actually makes, even though he tells everyone else that you only get 15 trades your entire lifetime. So it's not as if you're totally right. Oh, what's it going to be worth in 15 years? And maybe him and Munger, maybe they've had that exact conversation, but it's kind of like, your actions don't show that, dude. It's not like you're buying and selling Chevron like crazy. He hasn't held Apple for 30 years. He's held it for like what, 4 or 5?
Decade. No, I think it's like
really?
Yeah, maybe. I want to say they bought it in like 14, so maybe not quite a decade. Okay, like 8-9 years.
Yeah. I just don't.
Yeah, I mean, it's an anomaly of an organization. But I think I'm just saying that's the question you got to ask. And also, if you're specifically Warren Buffett or Charlie Munger, if you're talking about more than 5 years, not my problem.
All right. So this is from the 13F from Q1 2023, just to give you an idea of the activity here.
Yeah.
New purchases 3 stocks, additional purchases 7 stocks, sold out of 4 stocks, and reduced holdings in 9 stocks. He's going on 20-some trades in Q1. Like, it's not like he's afraid to sell. I mean, so that's my eye roll. Maybe I'll post some stats and we can talk about it.
Does Buffett log into his Schwab account to do this stuff? I know he does. Obviously, he doesn't. But
like, he writes it down on a piece of paper. Remember, I think he's still doing this, where his secretary prints out the emails and then he handwrites it back, and then she like scans it and sends it back to Gates or whatever. Like, he's not.
All I'm telling you is, if you're trading billions of dollars at a time, you better have some legible handwriting. All right, can I fishbowl reach? Or you got more to say? Yeah, I'm going to fishbowl reach. I got to rant a little bit, playa. I got to rant a little bit. And I don't want to. I do not want to do this, but Nick Maggiuilli, who we, over the last 2 years, if you go back and listen to some of our episodes, we talk about good writer, enjoy his thought process, respect how he respects money and how he's learning in the game, because he's relatively new. Yeah. Relatively, he's been writing for a few years, but relatively new to the game and respects it. I don't know what's gotten into him, but we talked about one of his pieces a few weeks back, and now I got another one that I'm just like, Nick, what the dilly be at, bro? So yeah, that's what I would say. If he was here right now, that's what I would say. So Nick writes his blog of Dollars and Data, and he has this recent post called Paychecks, Not Portfolios: Why Income is the Key to Financial Success. Basic premise of this thing, straightforward and simple, and sure would be how I would respond to it. And that basic premise is, if you don't have enough income to be able to save, then you cannot build wealth over time. That is the basic premise. And I get that premise.
Yeah. And that everyone's going to agree with that. Your savings rate has to be positive in order to build wealth, right?
Yeah. But the way that he goes about this is as if he's like, his life is threatened. And he's trying to, this is like a come at me and say something to my face if you don't believe this. Kind of the way he writes this, the tone is like super aggressive. But I'll say a couple of points that he brings out, which again, I think are spirit-wise fine. As time has passed, I've become increasingly convinced that the best predictor of whether someone is likely to build wealth is their income. It's not their asset allocation, their investment knowledge, or their financial goals that matter. Tell me someone's income, and that will tell me more about their ability to build wealth than just about anything else. The only word, in my opinion, he makes me drop vowels in my speaking here. The only word, in my opinion, that saves this paragraph is that in that last sentence, he says ability when he's talking about building wealth, and not likelihood or aptitude or something else there. But I would never write this down. This feels like it's there's no safety, I think, in fully believing this paragraph. I see no value in fully believing this paragraph. I see value in the idea of saying, generally, if there's more income, there's more I can save. Cool. So having more income allows me to increase my savings rate. It allows me to put more money away, etc. But just the flat belief that like it's all about the income, that asset allocation, investment knowledge, and financial goals don't matter.
Yeah, not so great. So I'm going to take a few deep breaths over there, Doogles. I want you to yell again soon. But let's move on to the second part of the paragraph where he goes to a Morgan Housel book called The Psychology of Money. Great book. We recommended it on the show. Highlighted a case of a janitor named Ronald Reed, who amassed more than an $8 million fortune when he died at 82. So the Morgan uses this example as a guy that was just super frugal, high savings rate, not huge income, and ended up with a nice chunk of money, right? Well, Nick went back. I would never in all my years think to do this. Nick went back and tried to backtest this and was like, I don't know, man, looks a little fishy. Is he accusing this janitor of like insider trading or something? I mean, like, why can't we just, first of all, Morgan's good enough that I'd assume he's validated that there was no fraud happening or whatever. But like, you have proof with this guy's fidelity statement that he is worth $8 million. You know, he was janitor for 67 years or whatever. I don't even get the premise of being like, Ronald Reed, nope, couldn't have made that money. Look at him. He needed a higher income to make that much money. What's going on there? Why even attack the story? I don't know.
No, the potential saving grace, if I'm giving Nick the benefit of the doubt in this, the potential saving grace is that what Nick is trying to do is not talk to individuals with this piece, but trying to talk to systems and saying, if we don't pay people more, we will not allow people to build wealth. That's like the potential saving grace in this whole thing, because I do like that later on in the piece, Nick talks about how people will sometimes, or maybe oftentimes, bash people that have less money and say it's because you spend too much, when it's not about them spending too much necessarily. They may not have enough money to not spend less. Like, he does say that. And that makes me believe that something that Nick might be trying to do is say, as a society, we should pay people more, because paying people more then allows them to save. That is potentially the only saving grace. But it doesn't fully read that, like, it doesn't fully read that way. And also, I just think if this is talking to individuals, it is not the mindset is not a helpful mindset for an individual to have. Because this mindset, to me, a mindset that can come from this is saying either A, which is, this is something I think we would collectively bash up against, is if you don't make enough money, don't worry about your asset allocation or your investment knowledge, because that doesn't matter. What matters is making more money. That is not a mindset that I'd want to put in people's heads. I do think that a potential mindset that could be good coming from this is, as you earn more income, you will be able to save more. And so make sure that you do, or something like that. But Nick, something happened. If you need help, skippydoogles@gmail.com, Nick.
No, and well, yeah, let's leave it there. I was not a fan of this. I think there's probably good intent, but maybe the tone came across wrong or something. Again, if the high level takeaway is what I would call common sense, which is if the bare minimum cost of living is $30K a year and you make $29K a year, you're not going to be on the wealthy train. Like, yep, we all know that. There is a certain threshold of income required to have a positive savings rate. And if you have a positive savings rate, regardless of how big or how small that is, you can make smart financial decisions with the savings that you accrue. And there's no judgment if those savings are small or large. On the Skippy and Doogles show, we're going to applaud that, right? And then there's ways, whether you grow your nest eggs through that positive savings rate, or you continue to go crush it at your job and make more and more money, there's ways to make smart decisions from there. But yeah, this high level takeaway that feels a little blind of like, oh, dude, you got to go make $1 million a year to be worth your salt in anything, I'm not really on board with that.
And lastly, before I turn it over to you for your next fishbowl item, the reason at the beginning of this I stated that it seems like Nick is bringing a threatening tone or something that feels unnecessarily soapboxy, I'm just going to read you the last paragraph.
Please do.
Lastly, before you argue that expense tracking or goal setting or manifesting your future wealth are more important than income, remember to bring data. I'll have mine. Who are you like, who is this geared toward? It's like, it sounds like he's backed into a corner and needs to either win this argument or it's life or death. I just don't, there's something behind this. And I don't know what it is. And Nick, if you're listening to this, we would love to know. Respect your work historically. Sounds like you're in trouble. Again, skippydoogles@gmail.com. Reach out, Nick. Okay.
Well, no, I don't get like who's out there, whatever, struggle to make ends meet, being like, oh, I need to talk to this financial blogger about how this is the perfect path forward. And I chose to do whatever instead of work at the hedge fund. Like, it's exactly. Not really, who's here to pick this fight? It's I don't think anyone's like, oh, I wish, or I'm purposely struggling to get a positive savings rate. Like, this doesn't exist. All right, like, let's continue talking about hogwash. So remember when I brought up the GPT portfolio?
Oh, yes.
One study came out from, I think it was the University of Florida, that said, hey, they used AI to pick stocks and it actually outperformed. And it was like not a very long study. If I remember right, it was 12 weeks or something. And my argument at the time was it's a coin flip. Anyway, some enterprising folks decided to do this with real live money. They made it so your retail investors, and I'm sure they're the same ones that love AMC and GameStop, could throw real money in alongside. And Doogles, I would think Actually, I should pull this up. I would think we're about 6 weeks in to this test as well. Drum roll, please. Do you think they're outperforming or underperforming SPY?
Underperforming.
Currently, SPY has returned almost 8%, and the GPT portfolio has returned 2%. Again, when this happened, I told you there was a slim chance, a 5% chance that they could get lucky with the roll of the dice. But no, they're like picking stocks every week or having their model pick stocks every week. Of course they're underperforming. It's basically day trading. And so here's the thing that fired me up about their latest tweet. It says, improvements next week include bringing more AI experts to the algo, stop losses, and more. So they're out there still thinking like, oh, it's the algorithm. Or like, if our stop loss methodology gets better, we're going to outperform. No, you guys are not going to outperform because you trade too much. This is tales of all this time. This is like basically never happened. If they did this for 100 years, I could guarantee they would underperform the index. Why?
Have you seen Forgetting Sarah Marshall?
Yeah.
So there's a scene in Forgetting Sarah Marshall where a surf instructor that is played by Paul Rudd is teaching, well, supposed to be teaching the main protagonist in this great film how to stand up on a surfboard. And the central theme of it is do less. He goes, do less. Oh, nope, you're doing too much. Do less. And eventually he just lays on the surfboard and he goes, well, we got to do more than that. But I do think that that's good advice for this GPT situation. Do less. Maybe don't do anything. Actually, you shouldn't have started the whole thing, but do less.
There is $33 million from 41,000 investors in this garbage, buying and selling different stuff every week so they can have alpha, which is outperformance, of -6%. Why, guys? This is stupid. It was stupid at the start. But what's hilarious about it is this happens a ton in the investing world. You do a back test that looks like it's going to work, and this isn't even really a back test because this is randomly throwing stock picks at AI, and it works one time, and then when you actually try and implement it with real money, it underperforms. It's how it works. Get out of that garbage.
Yeah, I'm gonna use that as a perfect transition over to this time machine I'm going to take you into. So whoop, 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 whoop. That's the sound of a time machine. I'm going to take you back to 2006. Conversation with a Money Master is the name of this PDF that I was spying, and it's an interview with Bill Miller, someone that's come up on the pod a few times. There's some solid gems, or even maybe I'll say this. There's some solid, going back to what I said near the beginning, discussion fodder that came from this, but also some gems, I believe. And one of them that I think relates to that point around AI is this. Are you ready for this? Efficiency. We discussed market efficiency before on the pod. This is going back even, whatever this is, 17 years here. We're talking about market efficiency. So what Bill says is in the current market, this is historical market, but in the current market, one of the changes is that hedge funds have made the market highly informationally efficient. And here's the important point. In the short run, the result, he says, is that the opportunity is about time arbitrage, which means that if you lengthen the time horizon that you're thinking about for an investment, the more likely it is that that investment might be able to outperform. The point here that I think is really interesting is because what he's saying, I'll say it a different way, but the same thing. What he's saying is if everyone, let's say all retail investors at least, have the same information today, then a short-term time horizon advantage is super difficult, if not impossible to have. It's just a guessing game. But no one has the information for what's happening 3 years out, 5 years out, 10 years out. No one has the information. What you can do is You can look at what your favorite like valuation methodology is. You can look at past results. You can talk to management. There's lots of stuff you can do, but that's a game of analytics, of experience, of whatever you can call it, whatever you might be. And so you can have it's possible to have arbitrage there, but in the short run, it's just a guessing game. Spit on it.
I think the most powerful thing to do is you can bet on mean reversion and say it's more likely than not. And that will happen with a longer time horizon. But almost every investor worth their salt, including guys like Seth Klarman, have said some version of this, which is, and Jason Zweig says this all the time, like the advantage of the individual non-professional investor that just crushes almost everyone else is an extended time horizon. If you can buy and hold stuff for 5, 10 years or more, almost none of the hedge funds, almost none of the professionals do that. And it's a massive advantage.
Let me drop another one. I thought this was a really cool way of thinking about something. So he says, passive management does not give investors the return of the index. It gives investors the return of the index minus costs. Mm-hmm. One of the arguments against active management is that it underperforms, but passive management underperforms every year forever.
True.
I just found that to be, now it's the easy argument to say, let's take this intellectually, because it's the easy argument to say, okay, yeah, you're buying a Vanguard fund, and so your costs are like minus 0.02%.
I mean, that cost can be so small that it's effectively like saying, if you get paid in cash, if you make all your transactions in cash for the rest of your life, you might lose a penny here or there. So, right, the intellectual argument says, well, you never get true value. You should do it a different way. But it's right.
Yeah,
I appreciate the thought experiment.
I think the point is, there are like a couple points you can pull from this, and these are not Bill Miller's points, but what Doogles is saying here is, the point is that if you want to outperform, you can't do it by buying a passive index. I think that's straightforward. And so if you want to outperform, there has to be active management. Now, I think the other point that Doogles is going to bring in here is, do you need to outperform? Like, for the general investor, and my answer would be no, you don't have to outperform. But Bill Miller is saying, if you want to outperform, it has to be with active management, because otherwise passive management, you're going to underperform every year forever. So take that straight up. I just think it's a cool way of stating it. All right, another one. 100% of it, I've heard this in various ways in other places too, but I like it. 100% of the information you have about any business reflects the past, and 100% of the value of that business depends on the future.
But 100% of the value about the future is judgments you have to make, which is significantly less reliable than the data you have that is trustworthy from the past. So Bill Miller in this interview even goes on to argue that he's teaching that to analysts, and often he's discounting the information that they have in front of them. There's validity to that. But the flip side of that argument for someone like me, who almost always invests based on the past information, is, yeah, at least I can trust that information. At least it's not some hogwash story, which the human brain is a sucker for storytelling, good and bad, that says, oh, this is where we are going. WeWork is at 16 cents a share or 21 cents a share, right? What was the story about WeWork 3 years ago? It was that it was going to dominate the new office space. Well, now they don't even think they have enough money to operate for another quarter or two.
Let's stick on WeWork for a second. I'm going to interrupt because, last week we were talking about gurus and their ability to predict. This week, I sent you a text, and that text said, if you are going to look at WeWork, look at it now. And if you calculate the return of WeWork from the minute that I sent that text until the end of the week, it doubled. I mean, this is brilliance.
So how much money did you make on WeWork?
What?
How much money?
Oh, sorry, the line is breaking up. I couldn't hear you. I'm not putting my money in WeWork. All right, another one. This is something that Taleb talks about, a whole bunch too, the author of the Black Swan. Part of what people insufficiently distinguish or confuse is the difference between frequency and magnitude. That is how often you're right or wrong versus how much money you make when you're right and how much money you lose when you're wrong. This is a point, we've talked about it a bunch. It's brought up a number of times. I think it's super important, and I'll hammer home all the time, is that it's not, I invested in 10 stocks and I made money on those 10 stocks. Mm-hmm. It could be I invested in 10 stocks and I'm making up numbers, but I lost 15% on 9 of those stocks and I made 5x on the 10 stock. And depending on what the weighting is between the stocks, I'm assuming equal there. Like, that's what's important. And it can be hard, I think, for the human brain to be able to acknowledge that and act or not on that. But it's a super important point. It's about the magnitude, not the frequency.
Agreed. I'm trying to let's stick on WeWork. Let me pull up market cap history here. WeWork in late 2021, based on the stock price, was valued at as much as $7 billion. Okay.
Yeah.
Currently, I think its valuation is currently more like 300 million. Right? Mm-hmm. This is not investment advice. If anyone's smart, you will run as far away from WeWork as possible. But what's interesting about this narrative is, at what point does the valuation of the company get so low that the brand value, simply because WeWork is in the lexicon of what people talk about when they talk about co-working spaces, actually exceeds the total value of the stock?
Does WeWork own its buildings? Do you know?
In most cases, spaces? No. In most cases, no. And that's why it's really challenging, because their landlords are in a tough situation because it's all commercial real estate, and their reservations were really solid until this last quarter, and now they flopped.
That's it. It's a tough spot. I was really hoping you were like, yeah, for the most part, because then there's some hope. Okay.
Come on. You think Adam Newman was going around being like, let's make long-term investments in our building space? No, he was going around lighting money on fire.
Yeah, he was trying to improve the world's consciousness. Yeah, I know.
Obviously.
This one, I think, somewhat straightforward, but I thought it was a cool point around dividends or share repurchases. If the company's shares trade at a big discount to what they're worth, management should repurchase shares. If the shares trade at or above what they're worth, management should be paying out dividends.
How many more Bill Miller points do you have? Because I have an article specifically on dividends. That's it. So let's transition there. Cool. So this is from NDVR. It's really deep in the weeds, nerdy on basically factor investing, but specifically talks about dividends. So it's called Income Illusions, the Challenge of the High Yield Stock Narrative. And it breaks down the good and bad with dividends. As you stated before, I don't think everyone knows this, but you should. When a company pays out dividends, the stock, the total value of the stock reduces by the amount of dividend paid. In a lot of cases, those dividends go immediately back to share repurchases. And so you don't always see this huge blip in the stock chart. But if you're a company and your enterprise value is $100 and you send 5 of that to shareholders, obviously you have 5 less in cash on your balance sheet, and the value of your company adjusts, right? So also, dividends are less tax efficient than capital gains in most cases. So there are a lot of people here that are going to argue high dividend stocks are bad because someone like Buffett, let's go back there, at Berkshire Hathaway, he's going to buy back shares rather than issue dividends, simply because of that point about tax efficiency, but also because he thinks he's the world's best capital allocator, and he might be. And so he'd rather make the decisions about where that cash goes, rather that it goes to repurchasing, whether it goes to buying more Apple stock, than just signing up and saying this, 2% goes back to the investor of my stock every quarter. He's just not going to do it that way. I think in the nerd world of finance, there's now a talking point that like dividends are horrible. And I want to push back on that a little bit. So the study comes out with a conclusion that actually says the total attributable the total return attributable to a dividend is 0. And it breaks down that effectively when you have high dividend stocks, what's happening is you have something else going on. Like that stock is actually a momentum stock, or that stock is actually a value stock. And that's the reason that the high dividend stock outperforms. But the study also says, sorry, I'm a soapbox here, Doogles. This is like the first line of the second line of the second paragraph. It says, we show that high dividend stocks have historically outperformed low dividend stocks, delivering higher returns with lower risk. So I don't really care if you dive deep into the weeds, what is driving that return, whether it's actually a value stock or it's actually a momentum stock. I think that takeaway is pretty dang powerful. High dividend stocks outperform. The reason high dividend stocks outperform is dividend is a proxy for basically a fact that it's deviated to the negative side away from its average value, and it's likely to return there. So am I too deep in the weeds? Is there too much nuance here? Like, let's not paint dividends as terrible. Are they perfectly tax efficient? No. Are they a perfect investing strategy? No. Should you make your investing strategy that you look at dividends and nothing else? No, because you're going to get burnt by looking in the rearview mirror. Some of these stocks with really high dividends have no chance of continuing that dividend in the future. The reason they have a high dividend is because they used to have a great business and it fell off a cliff and they haven't killed the dividend yet. But broadly, high dividends are not horrible. They actually outperform based on historical backtesting.
Yeah, I think maybe along the lines of your point, but if not, that'd be even better. Academically interesting, this stuff.
Yeah.
But you can kind of do this with a lot of things. Like if they're saying it's not about the dividend, it's about the underlying factors, it'd be like me saying it's really not about cash flow. Like you're saying it's cash flow. It's not about cash flow. Cash flow just represents that you can run your business efficiently and effectively. So just look to see what businesses are running efficiently and effectively and go for it. Go.
The perfect example on that exact one is it's not about cash flow. It's about profit margins. Well, how do you get cash flow? You have to have high profits. Like, yeah. So, yeah.
But then if you reduce that far enough, then you get to the place where we were, I don't know, 2 years ago. You go, well, actually, it's not about profit margins. It's about EBITDA. It's not about EBITDA.
No, you go.
It's not about that. It's about revenue.
It's about revenue. Because
it's actually not even about revenue. It's about volume.
Revenue.
It's not about revenue. It's about volume. It's actually not even about volume. It's about pitch decks. Like you can keep reducing this to wherever you want to. But I think, again, academically, it's interesting. But maybe to the point that you're raising, yeah, that underlying factor is great. If this is a solid proxy for that to start my research, then fantastic. And if someone's been able to pay out dividends at an increasing rate over 50 years, that's an indicator of something. Like that may not mean that the stock price is going to grow a lot in the future, but it's an indicator of something, and maybe that something's pretty good.
Doogles, those increasing dividends over 30 to 50 years actually has a name. It's called dividend aristocrat stocks, and they outperform like mad. It's a quality investing strategy simply because it says not only is this dividend predictable, it's never been cut, it's never been discontinued, it also continues to grow, which tells you so much about the underlying business, that it's profitable, that it's predictable, that it's consistent, that in that case, if you're buying a basket of dividend aristocrat stocks, it's not the best investing methodology in the world, but it's certainly better than thousands of others. Like it's pretty solid. So I just needed to push back on this. Yeah, if you're a real investing nerd, I think you can see both sides of this. And I'm not saying the takeaways are wrong, but it seemed like someone, I don't know, had a little too much time on their hands and wanted to say that the yellow truckle symbol is not actually orange, that it's actually
How is that
yellow
coming up every week? How is that coming up every
just
week?
Obsessed with it. Just obsessed
Oh,
with it. What else
goodness.
is in your Facebook?
That's all I got, man.
Yeah, I think that's all I got too. All right. Doogles mentioned it several times. Hit us, skippydoogles@gmail.com. Premium subscriptions available, skippydoogles.supercast.com. That helps support the show. And we'll talk to you all next week.
Danke.